Silver coin shops are drowning in metal, refiners don't want it, premiums are weird, and everyone on YouTube is screaming shortage. So what is actually going on? OG John AG here. This is financial warfare education, not hopium. Today we're going to break down why silver can be in a global deficit while local coin shops are piled to the ceiling with scrap, why refiners are saying no thanks at 90 plus silver, and what this mess really means for stackers, traders, and the next big move in the silver market. We'll walk through what's really happening inside the shop, what's selling, what's stuck, what refiners refuse, how this fits into a 6-year global supply deficit, the truth behind no shortage versus no shortage of this kind of silver, where the real risk and opportunity is for you. Stay with me, because this is the kind of nuance that separates people who survive this cycle from people who get blown out by headlines. Segment 1. Inside the shop, busy counters, silent backroom. Let's start on the front line. Harry's coin shop. On the surface, business looks strong. Silver is trading back above $90. The phones are ringing. Customers are walking in both to buy and to sell. Certain products move instantly. Mercury dimes, pre-1964 90% coins, and especially American silver eagles fly out of the display cases as soon as they're priced. From a distance, you'd think, market is hot, demand is strong, everything is great. But when you step behind the counter, you see the real problem. The back room is full of metal that can't be moved up the chain, piles of sterling silverware, old jewelry, hollow ware, world silver coins, and even US 90% in bulk that refiners won't touch at current levels. Harry literally points to carts and trays and says, all of this came in just last week. That's not an exaggeration. That's what a local flood looks like when high prices drag decades of forgotten silver out of the woodwork. So you have two realities at once. Retail cases, good demand for clean products. Backroom, overwhelmed with low-priority scrap that's effectively cash stuck in metal form. This is where the story starts. Segment 2, refiners' refusal. A polite, we don't want your silver. Now the key bottleneck, refiners. According to Harry and Adrian, here's what refiners are doing right now. They have stopped buying sterling silver, jewelry, flatware, hollowware. 90% US silver in big bulk quantities. World silver coins and odd alloys. They will still accept 39 0.999 and 49 0.999 pure bullion bars, pure rounds and bullion coins. Even for what they do accept, the terms are brutal, 3 to 4 weeks to even lock in a price. Shops can't hedge properly because they don't know the eventual lock-in date. If spot drops during that lag, the shop eats the loss. One refiner literally told Harry, send us the metal, we'll put it into the pool, and when we are ready to lock it, we'll email you with the price. Translated into plain English, we'll decide the price later, not you, and we're not in a hurry to do it. Why is this so dangerous for dealers? Imagine you buy silver from a customer today at a $90 spot price, paying them, say, $85, $88. You ship that metal to the refiner, wait a month, and spot is now in the low 70s. The refiner locks you in at 70-something, and you just lost money on the entire batch. Adrian calls it what it is, a formal way of saying we don't want it right now without outright refusing business. So what do shops do? They drastically pull back on what they buy. They lower what they're willing to pay. They stop touching certain categories altogether, especially sterling and oddball scrap. That's why the back rooms are filling up. The pipeline from public coin shop refiner is jammed. Segment 3. The viewer's question. Isn't there still a silver shortage? A viewer then asks the obvious question any stacker would. If refiners aren't buying and shops are drowning in scrap, how can there still be a silver shortage? Harry answers straight. Shortage and deficit are not the same thing. Adrian adds the macro context. The Silver Institute and other sources show we're now entering what will likely be the 6th consecutive year of a global silver supply deficit, meaning total annual demand, industrial plus jewelry plus investment plus solar plus other uses, is greater than annual mine supply plus recycling. So globally, the world is consuming more silver each year than it produces. The gap is being filled by drawing down above-ground stocks from scrap, old silverware, investor bars, and coins. Locally at Harry's shop, high prices have pulled a ton of that above-ground stock out of people's homes. That's why his cart is full and why he can say, no shortage here. Both statements are true in two different frames. Macro frame. The system is running a long-term deficit, inherently bullish and unstable. Micro frame. A local glut appears whenever price jumps and weak hands sell old metal. Harry even says it. There's scads of it out there in the form of old coins, sterling, flatware. But all that means is this. We are currently eating the legacy hoard to mask the structural deficit. That is not sustainable. It's a one-time harvest. Segment 4. Junk silver. Dead to refiners, strategic to stackers. Another viewer asks, with refiners not wanting 90% and shops overloaded, is junk silver still worth buying? Harry's answer is where the nuance shows. From a dealer, wholesale perspective, junk silver is a problem right now. Refiners don't want large bulk. You can't quickly convert it into cash. It's dead inventory if you're running a business. But from a stacker perspective, that same bottleneck has created one of the best values in the case. Harry says he's selling 90% at about $4 under spot, an effective discount just because the wholesale side is temporarily shut down. If you're a long-term holder who plans to keep silver through multiple cycles, especially with a barter potential mindset, that's huge. You're acquiring real silver below melt. You're not depending on a refiner for your exit. You assume your exit might be years later to another individual, not to a scrap buyer. The current dislocation is a gift, not a problem. So we have this paradox. Refiners and some dealers, we don't want 90%. Smart stackers with time, quietly loading 90% at a discount because of that exact reluctance. Again, it comes down to who you are and how long you plan to hold. Segment 5, the 6-year deficit. Explained in real-world terms, Adrian hammers the macro again. 2026 is likely the 6th year in a row of a global silver supply deficit. Here's what that actually means in everyday language. Every year, the silver bank account looks like this. You deposit, mine production, plus recycling. You withdraw, all forms of demand. For 6 straight years, withdrawals have been larger than deposits. The only way that works is if the account had a big balance to start with, above-ground stocks accumulated over decades. What Harry is showing you on camera, cartloads of sterling, jewelry, old coins, is that account being drawn down. This is the float that makes people say, look around, there's plenty of silver, no shortage. But once you understand it as a finite reservoir, the tone changes. Every surge in price pulls more forgotten metal into the market. Each surge drains the reservoir further. At some point, the easy scrap is gone and the deficits have to be closed by price, not liquidation of grandma's silverware. That's why macro guys talk about deficits the way they do, not as instant shortages, but as a slow process that ends with a sudden repricing when the reservoir runs dry. Segment 6, time risk. Why refiners are saying later. Another critical point, time risk. When refiners say, send it now, we'll lock the price later, they're shifting risk onto the dealer. In a stable, low-vol environment, that's annoying but manageable. In a crazy tape with $5 to $10 weekly swings, it's dangerous. For coin shops, their working capital is literally metal. If they can't quickly flip certain forms of silver, they're stuck. They're effectively running an unhedged trading book against future refiner pricing. So they adapt by avoiding categories with too much lag, sterling, alloyed, heavy scrap, sticking closer to products they can sell directly to customers, coins, rounds, bars, lowering buy prices or refusing certain deals to protect themselves. For stackers, this refiner time risk can actually be to your advantage if you're patient. You have no need to sell soon. You're disciplined about what you buy and why. It's the difference between a trader who needs a quick turn and a stacker who's thinking in years, not weeks. Segment 7. No shortage of silver versus no shortage of this silver right here today. This is one of the most important mental models from the whole discussion. When someone shows you a room full of silver and says, see, no shortage, you have to ask, what type of silver is that? Where is it located? Who owns it? And at what cost basis? Can it be easily turned into the form the industrial or investment market needs? Scrap in a coin shop is not the same as 1000 Oz COMEX deliverable bars, high purity product needed for industrial use. Specific products the retail investor market prefers, ASEs, maples, government coins. So you can simultaneously have plenty of old spoons and sterling trays, tightness and fine bullion, long backlogs at mints, shortages of certain coins at reasonable premiums. To a YouTube tourist, that looks like contradiction. To someone who understands commodities, it looks exactly like the early to mid stages of a squeeze. Metal exists. It's in the wrong form, wrong place, wrong hands. Converting it takes time, energy, capacity, and higher prices. Segment 8, stackers versus traders. Different games, same market. So what should you actually do with all this, depending on who you are? If you're a trader, you care about spreads, liquidity, and timing. This environment is dangerous. Refiner delays, widening bid-ask spreads, and sudden shifts in premiums can eat your edge. You want to stick to the most liquid, standardized products and think very hard before piling into forms that the wholesale market is currently rejecting. If you're a stacker, Tuck's long-term investor, you care about ounces, not this month's refiner mood. It may make sense to lean into forms that are temporarily unloved but structurally solid, like 90% at big discounts. But you also want a core base in highly liquid forms, e.g. 1-O's bullion coins and bars, for emergency liquidity. In both cases, understand that the 6-year deficit and above-ground drawdown are macro wins at your back if you're long silver. Understand that local gluts and refinery bottlenecks are noise unless you ignore them and get stuck on the wrong side of them personally. Segment 9. What this massive problem really tells you. The title of the video says, Silver and gold shops have a massive problem. They do, but it's not the problem most people assume. The problem is, the refining and recycling system was built for a calmer, lower price, lower volume world. 6 years of deficit plus price spikes are now forcing huge volumes of old metal into a narrow channel. That channel cannot process it all at once, so it jams, and dealers end up holding the bag. Zoom out, and that massive problem is basically this. The silver market is transitioning from a world of complacent abundance to a world of visible stress. First, you see refiners delaying, shops overloaded, confusing signals. Later, you see real shortages of specific forms, exploding premiums, eventual repricing when the scrap reservoir runs low. A room full of sterling doesn't prove silver is plentiful forever. It proves the system is starting to cannibalize its old hoard just to keep the machine running today. Outro. Read the structure, not just the pile. So here's the bottom line. Coin shops are flooded with scrap because high prices pulled hidden silver into the open. Refiners are refusing or delaying purchases of alloyed silver, effectively saying, we don't want it right now. Pure bullion still moves, but slowly, with time risk and price risk pushed onto dealers. Globally, we're heading into the 6th year of a silver supply deficit, demand mine supply plus recycling. Above-ground stocks are bridging the gap, but every cart Harry shows you is part of that finite bridge being burned. This is not the picture of a healthy, balanced market. It's the picture of a system working through the early stages of a structural squeeze. This is financial warfare education, not advice. Your edge is not to guess tomorrow's spot price, but to understand what kind of silver you hold, how the pipeline actually works, where bottlenecks become opportunities or landmines. If you've watched this far with your brain turned on, drop OG John AG in the comments and tell me, would you rather hold the silver that refiners hate today but might be gold in a reset, or the silver that everybody wants now, even if it looks expensive on the screen? OG out.